Good morning, good afternoon, good evening, wherever you are in the world, and welcome back to Sip&Talk. Hello to all our Sip&Talkers out there.
Welcome, welcome. The coffee is hot, the data is cold, and I am ready to get into it.
And I am particularly energized today because we are stepping right into the arena of pure, unadulterated investment anxiety. This isn't just about, whether you chose the right stock.
Oh, no.
It's about whether you chose the right life philosophy and someone else is making you doubt it.
You hit the nail right on the head. We got a note from our loyal listener, friend, and sort of our silent sponsor, Mickey. And he is seriously frustrated.
I can imagine.
He has a friend who just, casually flashed a screenshot of his investment account showing a massive stomach-turning 100% gain over a really short period.
The classic bragging rights scenario. So what was the secret sauce?
So the secret sauce was pure speculation. The strategy was, super high risk, chasing highs, cutting lows, basing decisions pretty much on gut feeling and momentum.
Right.
Now, Mickey's returns have also been excellent, but they're disciplined, they're systematic, they're, long-term.
Yeah.
And they involve significantly less drama.
And yet, seeing that quick, gravity-defying doubling, Mickey is now wrestling with what sociologists call relative deprivation. He's looking at his own steady, rational progress and wondering, did I miss the bus?
Exactly. Is my whole system flawed?
Is my entire discipline system fundamentally flawed because it didn't generate fireworks? And that feeling, for anyone listening, is almost as painful as actually losing money.
It is. It really is. And we need to address that anxiety head on while, injecting some serious financial reality. So Mickey and anyone else feeling this crunch, you need to clarify one thing immediately.
What is that?
Was that 100% gain the result of genuine replicable skill, or was it just a fortunate one-time statistical fluke? We are going to frame that quick success as maybe a temporary drawdown of beginner's luck.
Okay, yes. Let's take back control of this narrative. That's exactly why today's conversation is so critical. Our mission is centered around one profound concept, the qualification for deviation from the market. We're going to use behavioral psychology, the hardest data points available, and sound investment philosophy to help you, Mickey, and all our listeners take back the right to evaluation. You get to set the metrics for success.
Not some friend flashing a fleeting screenshot. That's the key distinction. We are defining the criteria you need to meet to justify deviating from the collective wisdom of the market.
And Mickey's actually doing something very sophisticated right now, which is, ironically, causing his current pain.
He is. He's running a concrete validation experiment. He set up a specific test period from Q4 last year to Q1 this year, meticulously tracking his hand-selected stock portfolio against the S&P 500 benchmark.
It's a scientific, rigorous approach. It's designed for long-term self-improvement.
But that quick speculative success from his friend is acting like a poison, just completely undermining his mental discipline mid-experiment. He's looking at his data, which is probably, 8 or 10% returns in that period, thinking, why am I putting in all this work when someone else got 100% just by betting big?
And we have to discuss the immediate negative consequences if he abandons his system now. Let's run the extreme premise. What happens if Mickey, seeing this doubling, suddenly scraps his rigorous, long-term system?
Oh, man.
His rules, his research, his carefully managed risk tolerance, all of it, just to chase those fast, speculative gains.
That is the financial equivalent of a panic attack. He would likely enter the market late, right at the top of the speculative cycle, and get harvested almost instantly. The momentum that fueled his friend's gain is already exhausted.
And worse, in that moment of panic, he destroys the logic underpinning his long-term approach.
Exactly. He loses both the short-term speculative game and the long-term systematic game at the same time.
It's a complete lose-lose situation born purely from envy and impatience. That's why we need to hold your hand through this, Mickey, and remind you of the core assertion that makes you a systematic investor in the first place.
I think the first mistake a lot of new investors make is viewing the S&P 500 or, the total market index as the safe or boring choice.
Right.
It's anything but.
Absolutely. Mickey, when you benchmark against the S&P 500, you are not looking at a conservative strategy. You are looking at the combined, distilled wisdom, the computational power, and the near instantaneous reflection of every single known public piece of information on Earth.
You're competing against the efficiency of the world.
You are, and that, for me, embodies true reverence for the market. Mickey's initial mindset is perfect.
Yeah.
The S&P 500 isn't a safety net. It's the strongest opponent imaginable.
And his core assertion sums up the mature philosophy we want all our listeners to adopt.
What was it again?
I am not competing against anyone. I am validating whether I am qualified to deviate from the market. That is a huge philosophical distinction. You're not fighting people for scraps.
You're fighting global efficiency. You have to prove you are smarter than the machine.
And that efficiency it's enforced by deep financial theory. The foundation of modern finance, really. The efficient market hypothesis, or EMH.
Right.
We don't need to get bogged down in all the forms, but the core idea is elegantly simple. The price of a stock at any given moment already reflects all publicly available information instantly.
Okay, so think about what that implies for Mickey's friend, who's chasing highs and cutting lows. When his friend sees a stock line wiggle and decides to execute a trade, those exact wiggles were already identified, processed, and traded upon 1 million times over by algorithms far smarter, faster, and less emotional than any human brain.
The modern market is just an information sponge. To generate consistent, long-term alpha, that excess return above the benchmark, you have to possess information or analytical capabilities that are genuinely superior to the average expectation of the global market.
Which means you have to be right when everyone else is wrong.
And you have to do it consistently for years, not weeks.
And the hard data reality backs this reference up. This is where we bring in the SPV report. That's the S&P Dow Jones Indices versus Active report. This document is just a dose of cold water for anyone who thinks beating the market is easy.
This is truly the cruelest fact in finance. We are talking about highly educated professionals, people who went to the best business schools, have advanced degrees, specialized terminals, teams of analysts doing proprietary research.
Right, the pros. And what does the SPV report show?
Over the long term, and we are talking 10 to 15 years, over 90% of these actively managed funds fail to outperform the benchmark.
Let me just repeat that. 9 out of 10 professionals whose full-time salary job is to beat the S&P 500 fail to do so consistently.
And why do they fail? I mean, it's not because they're dumb. It's due to 3 main factors. Their internal costs, which they pass to clients, the constraints of their mandate. They can't always invest in tiny, explosive companies, and maybe most damningly, herd behavior.
Herd behavior. They end up looking too much like the index anyway.
But they charge high fees for the privilege, exactly.
So if 90% of these well-resourced professionals can't do it, what mathematical probability does Mickey's friend, who is just watching squiggly lines on a charting app, have of being in that 10% outlier?
It's very, very low. His confidence is based purely on short-term luck, not statistically validated skill.
And this leads us to the most brutal and I think often overlooked reason why the index is such a superior opponent.
Which is?
Negative skewness and the 4% rule.
Okay, let's dig into this because this is where the conversation gets really interesting and counterintuitive. Most people assume stock market returns follow a nice, neat bell curve, right?
Yeah, a normal distribution. Most stocks are average, some are a little good, some a little bad.
That's the theory, but the reality is fundamentally different. Stock market returns are heavily driven by a very small number of exceptional multi-bagger super stocks. The distribution is skewed heavily to the negative. The majority of stocks barely move, underperform, or fail completely.
We have specific jaw-dropping data on this. Research published by Professor Hendrik Bessembinder showed that over the last 90 years, nearly a century of U.S. stock market history, almost all U.S. stock market wealth growth came from only 4% of the top-performing companies.
Only 4%. Think of it this way. Imagine the entire stock market is a lottery drawing. If you only buy 10 tickets and 96% of the massive, life-changing jackpots are concentrated in a tiny batch of tickets you didn't buy.
You are mathematically set up to lose from the start.
Precisely.
That is the ultimate challenge for any stocks picker, Mickey included. If your self-selected portfolio, a handful of high-conviction speculative trades, misses this crucial 4% of winners, it is mathematically guaranteed to lag the overall market.
And here's the subtle, often unappreciated genius of the index. It automatically keeps those 4% winners through its constant systematic adjustments. The S&P 500 is designed to hold the long-term success stories for their entire duration.
Whereas short-term speculative players, like Mickey's friend, often deboard these super stocks way too early. They might catch the first 20% gain, get distracted by the next shiny thing, and sell.
right before the real explosion.
Before the stock goes on its decade-long, multi-1,000% explosion, they got off the rocket ship to buy another bus ticket.
And if that wasn't enough drag, we haven't even factored in the friction yet. Transaction fees and taxes.
Ah, yes, the heavy sandbag strapped to the speculative runner. Index funds are, traveling light. They have extremely low turnover. They only buy or sell when the index rebalances, which is rare, and their management fees are near zero.
It's an incredibly efficient, low-cost way to move capital through time. Mickey's friend, with his chasing highs and cutting lows strategy, is trading constantly. Every time he buys or sells, he incurs transaction costs, brokerage fees, and maybe most importantly, in a short-term doubling scenario.
Short-term capital gains taxes.
Exactly.
That 100% gross gain, after you factor in taxes on short-term profits, which are often taxed at income rates, not long-term capital gains rates, plus all the trading costs, that 100% could shrink to 60 or 70%.
Meanwhile, the benchmark fund, which is holding for the long term, pays significantly less tax drag, often deferring gains for decades. It means the friend has to be so much more right than the market just to break even on costs and tax efficiency. The market is designed to reward patience, not hyperactivity.
Okay, let's shift gears from the cold, hard math to the hot, uncomfortable psychology. This is about why Mickey is feeling that anguish, and why his friend is so irritatingly confident.
We need a strong analogy here. Mickey's friend isn't a seasoned professional. He's like a novice walking into a high-stakes poker game, putting down a big chip on a hunch, and winning immediately.
And he walks away thinking,
wow, I'm a genius. All those complicated books on probability and game theory, utterly useless.
That is textbook financial Dunning-Kruger effect. When you have low-level cognitive players, people who don't yet understand concepts like risk-adjusted returns or the historical difficulty of stock picking, they look at the benchmark, the S&P 500, and call it a no-brainer, lazy, low-skill choice.
They equate low complexity with low skill. They think because an index fund is easy to buy, the wisdom behind it must be simple. But high-level players, investors who respect the system, like Mickey, see the benchmark as the embodiment of efficiency and collective discipline. They know beating it is a rare accomplishment, not a given.
The friend is operating with what we'll call first win overconfidence. It's a temporary high caused by luck, and it causes a severe underestimation of the long-term difficulty of the game. He thinks the market is static, but the market is a constantly evolving adversary.
And Mickey is suffering from a fundamental cognitive bias called the logic blind spot. Different opening times. This is so crucial for perspective.
Mickey's friend is running a quick lottery, a high-stakes, short-term gamble with an immediate payoff or loss. Mickey, running his long-term systematic approach, is running a late lottery.
Right.
You cannot statistically, logically, or emotionally compare an unfinished multi-year race to someone else's short-term finish line. The time horizons are completely incompatible.
It's invalid data comparison. And the market enforces discipline through mean reversion. Short-term results are heavily influenced by momentum, news cycles, and fleeting emotion. But the universe of finance is strict. Long-term results inevitably regress to the mean. They return to fundamental underlying value. That means the friend's 100% gain, unless it's rooted in genuine, replicable, fundamental skill, which we doubt, is highly likely to regress or crash later. It's unsustainable.
Therefore, Mickey's sole accountability must be for adhering to his system, not others' results. The short-term result is just noise in the data stream. We need to remind Mickey that consistency, even if it feels boring, is what creates long-term lasting wealth. Volatility only creates fast drama.
And let's take this to the extreme thought experiment. If the market were so easily beaten just by looking at a few lines and following momentum, the kind of stuff Mickey's friend is doing, why are the world's wealthiest, most sophisticated, and most cautious institutions so focused on indexing?
Think about the massive pools of capital. Take the Norwegian Sovereign Wealth Fund, sitting on trillions of dollars. They have limitless access to every expert, every piece of proprietary research, and global computing power.
And why do they still use global indices as the core allocation strategy for their national wealth?
Because they understand the collective wisdom and the compounding power of efficiency. If chart watching guaranteed stable doubling, then every AI scientist and hedge fund quant in Silicon Valley would have retired on a remote beach years ago.
They wouldn't be agonizing over neural networks and optimization models. They'd just be trading based on micro-RD crossovers. The fact that the smartest minds in the world still cannot consistently beat the collective index despite their resources should be the biggest testament to Mickey that his respect for the market is entirely justified.
Okay, here is the core professional concept that separates the disciplined investor from the lucky gambler. Risk-adjusted return. This is the quality metric. The friend's doubling might be masking an insane, stomach-churning level of hidden risk.
This is the dividing line. A gambler only focuses on magnitude, how big was the win. An investor focuses on quality, how smoothly and reliably did I achieve that return.
Let's use the coffee shop analogy again, but we'll flesh it out this time. Imagine two shops that both promise a 100% return on your investment. They sell you 2 cups for the price of 1.
Okay.
Shop A, Mickey's friend's shop, gives you absolutely phenomenal coffee, a high return, but the process is chaotic. You wait 3 hours, the temperature swings wildly, and the barista might randomly yell at you. High volatility, high risk.
I see where this is going. Shop B, Mickey's systematic approach, gives you really good, predictable coffee. It's always the same quality, the wait is 10 minutes, the environment is comfortable.
Exactly. Stable return, low risk. Mickey's looking for the best possible version of Shop B, a slight improvement in coffee quality without taking on the chaos of Shop A. The friend is gambling on the A shop outcome, ignoring the psychological cost and the massive chance of failure.
Mickey, if he truly has a system, is seeking the best value proposition, the highest return for the lowest possible risk path.
And if the friend doesn't understand the concept of risk-adjusted return, his 100% gain is built purely on courage, which is just luck in a suit, not actual structure or system.
So we need to introduce Mickey to the 2 hardcore metrics that professionals use to measure the quality of return. If Mickey's friend has never heard these terms, then his track record means almost nothing in the context of professional, replicable evaluation.
First, the Sharpe ratio. In simple terms, it's how much excess return did you get per unit of total risk or volatility.
And why is this so important for Mickey? It measures the efficiency and overall stability of his profit path. If Mickey achieved a 15% return with a Sharpe ratio of 1.5 and his friend achieved 100% with a Sharpe ratio of 0.5, Mickey is the superior investor.
Right. Mickey's path was smoother, indicating better risk management and a higher likelihood of replicability. The friend used brute force, not precision.
And second, the Sortino ratio. This is even more laser-focused on Mickey's internal pain point, which is losing money.
The Sortino ratio asks, how much return did you get per unit of downside risk?
This is crucial because it ignores upward volatility, which we generally like, and only penalizes volatility related to losing money. It's the X-ray that reveals the foundation. If the friend's 100% game is built upon a constant risk of an immediate halving the next day, the Sortino ratio will be terrible.
So Mickey has to ask his friend, that 100% return was great, but what was your average negative deviation? What was your Sortino ratio?
And if the answer is blank stares, then the return is pure speculation.
And this high-risk environment is ruled by the asymmetry of losses. This is a mathematical reality that fundamentally destroys momentum and speculative traders.
Let's use simple numbers. If your portfolio loses 50%, you don't need a 50% gain to get back to even.
You need a 100% gain.
Exactly. It takes exponentially more return to recover from deep losses. The killing power of drawdown is asymmetrical. The friends plus 100% gain sounds fantastic, but if it's built on a foundation of a previous 50% drawdown, he's only now back to what he started.
Meanwhile, the lower volatility of the S&P 500 comparatively allows for a much faster, smoother recovery because it avoids those deep asymmetrical hits.
And crucially, high volatility leads to a phenomenon we call emotional breakdown.
The friend's ego is certainly inflated right now. He feels invincible.
But when the market inevitably corrects and he faces a real 60 or 80% drawdown risk in his concentrated position, he is highly likely to panic. The chances of him sticking to his system, if he even has one, when faced with losing most of his capital are near zero. He will sell at the absolute bottom.
Locking in permanent losses. Mickey, by contrast, is validating replicability. A system that allows him to execute his strategy consistently and, crucially, allows him to sleep at night even when the markets are unstable.
That ability to stick to the plan during a market downturn is financially worth more than any quick 100% gain.
So we can summarize the source of their return simply through alpha versus beta.
Mickey's friend's return is primarily from beta, the general macro environment rising, plus an extremely high exposure to volatility and maybe leverage, which inflates the results. He is poorly positioned for the tide turning.
Mickey's pursuit is different. He is testing his ability to generate true alpha, that is, The excess return derives solely from his research, selection, and discipline achieved at a comparable or lower risk level than the market. He is testing his genuine capability.
Not just riding a lucky wave.
We've established that Mickey needs a professional report card. Now, we're going to dive into the core risks Mickey's friend is likely ignoring in his portfolio construction, which is central to determining Mickey's qualification to deviate.
Absolutely. The first step in professional portfolio construction is knowing what risks you can eliminate and what risks you must accept. We break risks into two main categories.
First, systemic risk, or market risk. This cannot be eliminated by diversification. It affects everyone. This is when the Fed hikes rates, inflation hits, or a geopolitical conflict erupts.
All boats rise and fall with the tide.
Right. And second, non-systemic risk, also known as idiosyncratic risk. This is the risk specific to a single company or asset. This is the friend's hunting ground.
The risk that one company has bad earnings, a CEO scandal, a new product fails.
And here is the basic rule of finance that Mickey's friend is almost certainly violating. By holding approximately 20 to 30 different stocks across sectors, you can neutralize over 90% of non-systemic risk.
This is fundamental portfolio theory. If the friend is betting heavily on just 2 or 3 speculative stocks to achieve his 100% gain, he is willingly playing with avoidable risk. Professionals call this ineffective adventurism.
He's taking unnecessary risks that basic diversification would mitigate instantly, exposing himself to catastrophic single-company failure. And we must talk about the market's true danger, the extreme event, the fat tail distribution.
This is the mathematical reason black swans exist. People assume the market follows a normal Gaussian distribution, where extreme events, like a 10% drop in a single day, are statistically almost impossible.
It's supposed to happen once every 1,000 years or something.
Right. But history proves the market follows a fat-tailed distribution. Extreme events happen far more often than statistics predict because human behavior is not rational.
Look at the historical data for the S&P 500. Single-day drops exceeding 5% happen dramatically more often than the normal curve would suggest. We saw it in 87, 2008, 2020. The tails, the extremes, are thicker, meaning the unexpected is more common.
Mickey's friend is currently enjoying the extreme right tail, the gain tail. But the extreme left tail, the crash tail, is equally likely to occur, and it occurs with greater frequency than predicted.
And this is where the index provides its ultimate protection. The index has an automatic adjustment mechanism. When a single stock gets into extreme trouble, it gets kicked out, or its weight is minimized. Single stocks, the kind the friend is playing with, can go directly to zero.
A permanent, unrecoverable loss. The index shields you from the total destruction of one component.
So, Mickey, if you want to validate your system and prove you are qualified to deviate, you must present these 3 specific report cards at the end of Q1. These are the metrics professionals use to judge skill.
Indicator number 1, the beta coefficient. This measures your portfolio's sensitivity to market movement. If the S&P 500 moves 1%, how much does your portfolio move? That's beta.
And if your portfolio beta is, say, 1.5, meaning when the market goes up 10%, you go up 15, that doesn't necessarily mean you're a genius.
No, it often means you are using cheats, either by leveraging up or simply being concentrated in the most volatile stocks. True qualification for deviation is winning with a beta near 1 or lower. That means you are generating alpha efficiently without taking excessive systemic risk.
Indicator number 2, maximum drawdown, or MDD. This measures the deepest psychological pain your system experienced. It tells you your psychological resilience.
You have to compare your MDD to the index. According to Bloomberg data, even in strong bull markets, the S&P 500 often has 10 to 15% corrections. That's normal volatility. If your friend's 100% gain involved a 40% shrinkage at one point, that indicates profound system fragility.
Mickey must verify if his system is more shock-resistant than the S&P 500 itself. If you can't survive the temporary dips, you don't deserve the ultimate peaks.
And indicator number 3, tracking error. This is the degree of difference between your portfolio's movements and the benchmark's movements. A high tracking error means you have strong subjective stock selection. You're picking stocks that move differently than the index.
But Mickey needs to verify one critical thing. Is this difference generating verifiable alpha, excess profit with high quality? Or is it just generating random noise and unnecessary deviation?
If your tracking error is high, but your Sharpe ratio is low, you're just taking a complicated, scenic, volatile, and ultimately unprofitable route.
This objective analysis brings us back to the philosophy of market respect.
Let's refine that analogy. Mickey's friend is running through a sudden, heavy thunderstorm without a coat. He's temporarily sheltered under a lucky overhang, laughing at Mickey, who is wearing a reliable raincoat.
The market is that raincoat. Many people think deviating is about earning more, but the index's main role is to keep you in the game when the storms inevitably hit. It's about longevity.
And this philosophy is why Ray Dalio, founder of Bridgewater, constantly stresses all-weather portfolios. He is a market genius, yet his core design philosophy is survival first. He has seen too many supposed geniuses who double their money one year and go completely bankrupt the next.
Because they didn't respect the inherent risk of the fat tail. Respecting the market's authority is fundamental to long-term survival and avoiding catastrophic, permanent loss.
Okay, Mickey, and everyone listening, we have covered the math, the data, and the risk metrics. But let's zoom out to the final existential question. When you're feeling that anguish, you have to ask yourself, is this truly investing, or is it just a psychological game?
This is where we bring back the extreme premise and put Mickey's conviction to the ultimate test. If the friend doubles again next month and Mickey stalls at, say, a very respectable 4% for the quarter, would Mickey discard his 3 years of built logic?
His entire systematic framework.
His whole framework to chase that impossible high? If the answer is yes, then Mickey never truly possessed a system in the first place. He was just running a highly controlled experiment he was prepared to discard at the first sign of external temptation.
A true investment system must possess internal logic that can withstand the noise generated by others. We need to focus on capability premium versus borrowed luck. What is the true source of that return?
After subtracting the beta, the general market tide, how much alpha is genuinely left? If the market rose 10% and the friend rose 100, but his volatility was 5 times higher than Mickey's, then that 90% excess return is highly volatile and inherently unstable.
It's a random spike, not a repeatable process. And here is the market analysis warning. Short-term excess returns often come from concentrated, dangerous risk exposure. We often see this mean reversion. Statistically, the friend's gain is borrowed luck from his future self.
Meaning the market will likely demand payment, offered with interest, in the form of a severe, concentrated crash later on.
And this is why we have the wisdom of John Bogle, the legendary Vanguard founder. His advice applies perfectly to Mickey's anguish. Don't look for the needle in the haystack, buy the whole haystack. When you try to pick that 4% of winning stocks, you take on massive, crippling, idiosyncratic risk.
But when you buy the whole market, you automatically own every single winner, effortlessly.
This leads perfectly to Nassim Taleb's concept of fragility versus anti-fragility. This is the philosophical core of Mickey's long-term survival.
Mickey's system, because it includes a regression mechanism, a plan that says if my alpha is consistently negative or my risk metrics are too high, I will return to the index allocation.
That's not a failure mechanism.
No. It's an anti-fragile system. It acquires experimental data, learns from its mistakes, and improves, making it stronger under stress.
Short-term players, like the friend, have a fragile system. Their logic, chasing momentum, using high concentration, it fails instantly and catastrophically in a market crash. Mickey's system is built with the humility to admit error and course correct. That's the definition of resilience. It is built to survive.
And finally, Mickey, you must focus on reclaiming the right to evaluation.
I think we can all agree the hardest part of investing isn't losing money. It's what we called earlier, seeing others make money and you don't. That is the raw power of relative loss aversion, and it's a constant psychological pull.
But the core mantra must be this. Investment is a marathon built on the slow, boring power of compounding, not a sprint built on luck. Mickey must only be responsible for his system's consistency, not his friend's timing or volatility exposure.
If Mickey finished his quarter with a 6% return, but his Sharpe ratio is far higher than his friend's, Mickey is the one with professional quality. He achieved his return with structure, discipline, and managed risk, and that is what guarantees long-term success.
So here's a final provocative thought for you, Mickey, and for all our listeners. If your investment process cannot be replicated in a bear market, you don't have a system, you have a seasonal hobby. The true test of qualification isn't the return you get in a bull market, but the return you protect in a crash.
Mickey, we sincerely hope this provides you with the ammunition, the data, and the philosophical grounding you need to finish your experiment strong and with conviction.
To all our Sip&Talkers out there, we encourage you to perform your own validation experiment. Define your system, define your time window, and define your risk metrics. If you win, congratulations, you are qualified to deviate. If you lose, it's a rational, disciplined choice to return to the benchmark. That is the mature path to long-term wealth growth.
And remember, this entire discussion is not meant as criticism or discrimination against any specific style or person. We are simply providing objective analysis of financial facts and calling for independent, data-driven thinking in your financial lives. We want you to be the master of your own system.
And please note, we are not licensed investment experts. All the data we provided today, from this SPA report to the 4% rule, is for educational reference only, intended to aid your independent critical thinking. Always do your own research.
Now, before we sign off, a huge shout out to Mickey's YouTube channel, Mickey to Life. He is proving that people who focus on discipline are also interesting people. If you want to follow his journey, you can check out his channel linked in the show notes.
Specifically, his latest travel vlog just dropped, and he has a hilarious rant about how Denmark gave him a hard time. Seriously, it's great. Go check out the video and subscribe to his channel.
And if you like today's discussion on efficiency and risk, please subscribe to the Sip and Talk podcast wherever you get your listening done. We appreciate you being with us.
We'll see you next time.